great pleasure to bring on board Ravi Dharamshi, CIO with ValueQuest, to talk about the way forward for 2023 and what one should expect in terms of the big theme for this year. Ravi, on behalf of everyone from ET Now, season's greetings, wish you a wonderful year ahead.
Good morning and Happy New Year to you and your viewers.
We are starting a new year with Ravi as our first guest, which means expectations are high from our viewers. They expect to hear
which
something
means I didn't go out of town for the New Year.
We are the only few ones who are in town, right?
That also means that they're expecting a money-making idea to start the new year with.
No, I think, and of course we try to do this annual thing, but market has its rhythm, but it doesn't necessarily follow a calendar year. I think just to give a bit of a backdrop of what has happened in 22, we were kind of expecting India to outperform in the world because finally India had a strong balance sheet, India had a low leverage, and the strong growth remained strong. So India was expected to outperform, which it did. However, at the below the surface level, the growth stocks or the mid cap, small caps did not do as well as expected. So some amount of internal realignment happened in Indian markets as well. So I think going forward, I think the current trend is likely to continue for a foreseeable future until Fed pivots, and then some of these mean reversion trades again will go back, and the main trend, the secular trends will revert back.
So describe that point for us. When
Sure.
we, let's say, started 2022, hindsight, I can say it's been a difficult year to call.
Sure.
But some of the trends were very easy.
Yeah.
Interest rates would go higher.
Yeah.
It did. Quantum is where we are debating.
Yeah.
Fintech and consumer tech had become an Humpty Dumpty and they've had a great fall. Quantum is what we're debating. Value stocks were getting a stepmotherly treatment. They've made a comeback. So these were obvious trends in 2022 Jan. What are the obvious trends for 2023?
No, so you absolutely hit it on the head. So, even if we get the fact that there is going to be a recession in developed markets, most probably in US as well, still how the markets are going to react is not is anybody's guess. How much of that recession is factored in remains a question. And I think you very rightly said, we are not debating whether there will be a recession or no. Because of the way the interest rates have gone up, it is pretty evident that there is going to be a slowdown. Now, whether that is a mild recession and a short recession, or whether it is a long, protracted and a severe recession is the only question in everybody's head. And of course, the second order effect of that is how will the US markets react to that, and subsequently how will Indian markets react to that. So I feel to a large extent a slowdown in global economies is a positive for India, and India will continue to outperform. But on a absolute basis, that's not a very good environment to create wealth. So if the world was to actually start recovering, India's outperformance will actually stop, I feel. But at the same time, on an absolute basis, India will actually do well. So there is a positive, for example, I think China and other emerging markets have done far worse, and possibility of a stronger bounce back there is more than what is in India. But India, even if we gain 10-15% from here, I think that would be a great outcome for India from the current year's perspective.
If I can just come in here, sure. While you're saying that this is known that there is going to be a recession in US, what could be a wild card this year is China, right? China reopening, how is that going to impact India? What's your take with respect to that?
No, so I think China will probably in the first next few months, there is going to be adverse data coming out of China as they open up. But eventually, opening up is the biggest stimulus that you can provide to an economy. And China will gain strength. And we are already witnessing that to some extent metals are beginning to outperform, the commodities are coming back, dollar is also starting to weaken. So some of those pro-China trades will be in action at least in the early part of the year. So Nikun, just coming back to the earlier question that you posed, what are the trends which are very, very visible? I think one trend which is of course panning out with a little bit of lag is that the private equity market is seeing a funding winter, and that is likely to continue. And a lot of markdowns are yet to happen over the next 6 to 12 months. A lot of markdowns will happen. With this, what the second order impact of that is on the Indian economy is that all these discounts that we've been enjoying from the startups are going to go away over a period of time, because every business is trying to finally chart a path to profitability, and that will mean a little bit of rise in the consumer inflation. So I think that is one trend that is visible. How to profit from it is a separate thing. But then one more trend that I feel is very strongly unlikely to continue forward is the India's outperformance. So again, but I am an absolute return investor. I am not a relative. I am not I don't have to figure out which is going to be the best performing market in the world. I have to still focus on the absolute return. From that perspective, I feel India is still going to give a absolute positive return.
Somewhere in 2022, you changed the anchoring of the portfolio.
Yes.
You moved back into financials, you sold out or you reduced exposure to IT and pharma. 6 to 8 months, do you see that anchoring to continue?
Yeah, I think we don't see any reason to change our portfolio positioning. I'll just give you how we had changed. I mean, just a recap of that. So we had broadly moved away from global focused sectors, from sectors that were pricing in a lot of growth towards manufacturing was one trend which we believe is going to go, is going to rise over the next decade. Second was energy transition. Third was a cyclical recovery and a capex recovery in domestic markets, releveraging of the economy. So these were the four broad trends that we were bullish on. We continue to stay bullish on, and there is a lot of outperformance that is happening in this space also. And when I said manufacturing, it covers a broad range of companies, right from outsourced manufacturer to chemicals to electronic manufacturers, defense. All those are covered under the manufacturing.
How much is manufacturing as part of your portfolio?
I would say at this juncture, it would be closer to 25-30%. I mean, it's top of my head. I'm not sure exactly what it is, but it would be 25 to 30% would be manufacturing. About 35-40% would be financials, and rest of the themes make up the others. Sorry?
So 25%?
No, so still there's almost 1/3 portfolio left.
Okay. And what is that 1/3 portfolio? Yeah. See, Anisha Priya.
No, so as I mentioned, so some of the cyclical recovery plays, whether it is real estate or whether it is capital goods, those kind of themes are featuring in our portfolio.
Anisha?
But you talked about the winter that the startup world and the new age tech is facing. But given the fact that we have seen deep correction in all of these counters, is there a case to be made to maybe look at some of these as big risk reward plays?
So you are right. The listed space of the startup world has faced the correction, but it is the private world which has not yet seen the markdown. And though I was talking about that particular private equity world seeing a markdown. The listed space has seen a lot of derating. I would say they are closer to reaching a place from where one should be betting on than being worried about a 50% kind of a capital erosion in those stocks. But however, you still need to figure out which are the ones that are going to survive this funding winter, which are the business models that can survive and stand on its own. If they need further capital raise, then that is a challenge. I would not bet on those kind of business models.
I have a simple follow-up question. You've sold out of IT because you don't want to buy sectors with a global challenge, whether it is metals or IT. But Indian manufacturing sector also ultimately is dependent on global growth. And I'm just looking at instances like what soundbites we're getting from garment exporters, what kind of feelers we're getting from some of the machinery exporters. All of them are saying that, look, if world slows down, it will start impacting our order book. So if we are in for a real recessionary stroke slowdown and opening up of China, which is negative for Indian manufacturing, don't you think the manufacturing theme somewhere will get challenged?
No, you're right. We will do far better if there were global tailwinds rather than headwinds, no doubt about it. But see, India is a play on incremental market share being taken away from China. We are not really charting new growth territories, essentially. It is a realignment of the supply chain that is benefiting India. And I don't see that trend changing. So even though China will open up and that will lead to some amount of commodity inflation, but I think most of it is now behind us in terms of, so we are actually still suffering from gross margin erosion because of the inflation last year, whether it was in freight or RM. Going forward, I think India will do well in terms of managing those cost inflation. I am still again not expecting a new commodity super cycle. It is just a reinflation trade to some extent that we are expecting. So I believe the longer secular trend in manufacturing in India will continue, and India will have to navigate these cyclical headwinds from time to time in terms of RM inflation and in terms of global slowdown. Yeah.
No, Ravi, you also look at, let's say, your portfolio from a bit of longer period. It's not just a positional trade, it's also 3 to 5 year view.
Sure.
With respect to that, how are you looking at autos? Is it the time to perhaps bet on two-wheelers now if you have a 3 to 5 year outlook?
So in our scheme of things, we are very positive on autos, but our preference is more commercial vehicles, then passenger vehicles, and then two-wheelers. We are not very bullish on two-wheelers. From valuations point of view, these companies are trading at a really attractive valuation, but the trend of EV adoption is actually eating away into their share. So the growth is going to be a big challenge for some of these two-wheeler manufacturers. So I will keep my eyes open. I think that market is in a state of flux where the disruption has actually hit them or is hitting them at this point of time. We have to see. There will be a phase of consolidation at some point where again this funding winter will end up hurting these startups, and if that happens, then maybe some market share shift can start happening again for the guys, those who have stronger balance sheet, brand and distribution, which is the incumbents over here. So I will keep my eyes open. I am not at this point of time placing my bets on two-wheelers.
Tesla is down some 65%, 70% broadly.
True.
That is the linchpin. That got everyone excited that what Tesla has achieved, if you walk on the same path, we will get a zero in front of a market cap. So if the linchpin, the real hero here is down and chips are down, could this actually lead to a derating in EVs? Because a lot of EV stocks, whether it is a stock like Tata Motors or Mahindra & Mahindra after that EV deal, or some of the EV ancillary, they got re-rated between 2020 and 2022. What are the chances they could go the fintech and the consumer tech way?
So first of all, I think Indian market, there are hardly any EV listed plays available.
Indirectly.
So yeah, there are indirect plays available. So we have not had that kind of price rise or market cap gains which can lead to that kind of erosion. The number one reason for Tesla price erosion is more to do with the valuation of the stock rather than the performance of the company.
I like the fact that you can talk on global stocks, but you never give a view on Indian stocks.
Well, that's how the regulatory perspective is over here. I mean, if I talk my position, it comes across as I'm trying to basically...
But your top
It's
holdings
factual.
is something which is available on your website, just for reference.
Sorry?
Your top couple of holdings are available in the public domain.
They are available in the public domain, but not so easily.
Okay.
You'll make us do the hard work to get to those, right?
Okay. My next point is, there are some mega trends which are always at play. And just for the benefit of our viewers, I'm bringing this point out, which is that, let's say if you bought into the private bank themes in 15 years ago, it's worked like a charm. Banks like HDFC Bank, ICICI Bank, irrespective of the volatility, they've really compounded like a charm. Then came the NBFC theme, then came the consumer theme. What is the large compounding theme for this year? For this, not this year, but next couple of years? Yeah, well, you would say in MOSL tagline, buy right and sit tight.
No, so clearly defense was one theme and we continue to believe defense is one theme that will do well from here as well. See, this is literally the birth of defense manufacturing that is happening in India. What we did is essentially put in place a mechanism where we have to procure locally. And there is a negative list out there. We cannot procure these items from outside India. So there is no choice but for this manufacturing to happen in India. This is roughly about incremental 1,25,000 crore kind of production that needs to happen in India over the next 5-7 years. So, and some of these companies were very small in vis-a-vis compared to the opportunity size that it presented. Now, one leg of that re-rating has surely happened, but I believe the story is not over. After some amount of consolidation correction, the theme will continue again. Second theme that I'm very bullish on from a 5-10 year point of view is energy transition. See, the world is rapidly moving towards renewables and there is no choice. And earlier it used to be driven by regulatory, no more. Now it is driven by economics and energy security needs. So when these kind of drivers are there, it is very difficult to, I mean, you have seen what has happened with Russia-Ukraine war. The energy costs have gone through the roof in Europe. Every nation is going to think for itself, how can I make my nation more energy secure? The beauty about the renewables is, whether it's wind or solar, is that I can produce it locally, I can produce it cheap, I don't need to depend, I save on my forex currency as well, and I am secure in my energy needs. So it is a huge shift that is happening. It will eventually lead to a just like we have that Maslow's hierarchy of need, where we put now Wi-Fi below the basic needs. Below Wi-Fi, there will be power as well. Power will become free. Incremental cost will be almost free, if not free for sure. So in that kind of a scenario, we have to think, how will the manufacturing cost, industries where power is a huge cost, can turn out to be a huge winner over the next decade if this was to come true. Of course, it's something that we'll keep monitoring whether it's happening or no, but I feel a dramatic shift is going to happen in the manufacturing cost, whether it is a people cost because of automation, or whether it is the power cost because of a renewable shift that is happening. So I think exciting times lie ahead of us in terms of figuring out the first order and second order winners in the energy transition theme.
Nisha, I was in Delhi, and where I was staying with my in-laws, the neighbors next door, they actually had a energy sunroof. Really? And generally, we met to exchange greetings over the weekend, and they've invested some money, and they think that, look, this is sufficient not only to take care of the energy what they need or the electricity what they would consume, they actually would be able to pull it back to the grid. So there are a lot of households in Delhi, in Gujarat, we already know the success story, even in Maharashtra. See, Bombay it's difficult because you live in tall buildings. How does the society divide all that? It's complicated. But you can see that in residences also now, this entire transition really seems to be visible.
No, but Ravi, what's the first order impact, and how to play this energy transition theme? Is it like get out of the likes of NTPC, etc., bet on Tata Power, JSW Energy who are getting into it, or is it Inox Green, Adani Green of the world? How to play this theme exactly in stock markets?
So obviously there are the equipment suppliers. See, in any gold rush, usually the first beneficiary is the equipment supplier. So you have to focus on who are going to be the suppliers to this supply chain. Clearly, India does not have a play at this point of time. China is dominating over there, but we are putting in place a framework where most of the supply chain we will try and have on our own. For example, a couple of days back, I think Adani announced that they are going in for a 10 gigawatt end-to-end, right from polysilicon to module kind of a structure. So those kind of things are going to happen. So people supplying glass, people supplying modules, wafer, those are the guys those who are going to benefit first. Maybe there will be a second order impact on metals as well, because usage of aluminium is high in solar renewables.
Anisha, just think about it. You are a sunlight abundant country, and you are a hydrocarbon deficient country. That's the regional geographical setup of Indian subcontinent. And what Ravi is saying is actually just going to be the mega trend in making now. Ukraine has taught everybody one lesson: food security and focus on your energy need. So Ravi, two more questions. There are groups which have got re-rated. It may be a coincidence, but that's how markets have done. For example, Chandra takes over, Tata Group across the board gets re-rated. 2022, hands down, just about anything which has a prefix or suffix Adani got re-rated. Didn't matter what the business was, but as long as it was an Adani Group of stock. What to your mind could be that headline group for 2023, 2024? I've looked at the compliance. There is no regulatory problem to talk about a group.
No, I think, see, let's understand what are the reasons. Why did these particular groups re-rate? Because there was the underlying value in the business was there, and there was inefficiencies in terms of capital allocation, in terms of cost structures, and those were easy pickings for, it still needs to be done. It's not like just because somebody new has come in, it will be done. But you can expect the old guard is going to be the last one to make those changes. Usually there are vested interests and which prevent them from doing. So whenever you see any kind of a change at the top, those are the reasons to start looking at it, whether they are making the right noises, whether headed in this, whether your interests are aligned with the particular group or no, in terms of market cap creation, the value creation, if that is the case, then for sure that will happen. I think since you asked, and I'll give you a name, one group that has undershot itself yet, and there is a lot of potential, is Mahindra Group. I think there is a lot of scope for improvement over there. The change has happened at the top, some time has passed by. I think all the right noises are being made. Probably the pace that you would want is lacking over there. But I think that's a group to keep on radar.
What about HDFC? HDFC Bank has underperformed, HDFC Life has underperformed, HDFC AMC has underperformed.
Right. No, but that underperformance, I don't think is due to the fact that there was a leadership lacuna, so to say, or the focus was not there on that is more to do with probably now actually it is undergoing a period where the focus is more on other things, like getting the merger right, getting the synergies right, rather than on getting the immediate factors like market cap creation and all will come eventually. So you are right, from next 5 years point of view, HDFC Bank is providing a fantastic entry point. Again, with disclaimer that we do own it, and we are looking to probably add also, but again, it's a 5-year call, it's not a 3-month, 6-month call of outperformance. It's a fantastic entry point, and one should be looking at it and evaluating it.
I have a standard disclaimer which I have made for everybody who comes on the channel, which says that we own HDFC Bank.
So we
don't worry
didn't
about
own HDFC Bank for the longest period. So
no, I mean last 6 months. Last 6 months is a standard disclosure. So my question is that apart from HDFC Bank, what else do you own?
So our view has changed on HDFC Bank very, very recently. It's not been a positive view on HDFC Bank at all. In fact, we were very much, so we do take a very concentrated bet, and we focus on picking stocks one versus the other rather than taking a blanket call on the sector or making a basket call. So yeah, incrementally from this point on, I think HDFC Bank is a fantastic opportunity. Yeah. So again, coming back to your question, I think HDFC Life is underperforming more because probably the life insurance space is undergoing a competitive scenario. AMC is underperforming. Actually, the best of AMCs in terms of AUM coming in is behind us probably. Incrementally, it is going to slow down. It is not going to be as much as it
like
has
yours,
been.
you guys are getting market share, fresh flows are coming in. Your growth is definitely higher than what the industry average is.
True that. So absolutely, whether it is newer products which are taking away market share or whether it is underperformance of the scheme, but I think the key factor in the AMC business is the profitability. That has been, the yields have been on constantly been going down since a long period of time, and that I don't see changing immediately. But some amount of stabilization will come in, and as you rightly mentioned, because of the underperformance in the last 4-5 years, some amount of value has come back again in the companies.
Ravi, have you made any bet in the public sector banking space?
No, we have not.
Do you feel like you've missed the bus? Is there a FOMO feeling to it?
No, I think we were very clear. It is a tactical trade rather than a secular investment bet. See, we hold that view that if our interests are not aligned with the promoter over here being the government of India. So at this point of time, with the releveraging cycle, with the credit cycle picking up, the cheap stocks are also getting re-rated to some extent, and they have a good liability franchise. But I believe these are the players that are ripe for disruption over a 5-7 year period. Their lunch is what is going to be eaten away. It has been being eaten away by private banks. Sooner or later, the new age fintech companies will also take away whatever the profitable part is left, will start getting eaten away by these fintech players. So it is good for a 6, 12, maybe 24 months tactical trade, but not beyond that.
Ravi, since we're looking back at 2022, and while this is not a FOMO moment for you, what is that regret for 2022? Anything that you missed out?
Clearly, I would have had probably, I mean, if I, instead of taking a PSU, even if I can find one particular bank which is government owned where I believe there is some amount of alignment of interest, like maybe State Bank of India or something, would have probably done as a decent.
I thought you'll say you missed watching the final of France versus Argentina. First, we're not talking about
it. I didn't miss it. It's just that I didn't see it in Qatar.
Exactly. I mean, you missed watching it in Qatar, in the stadium.
No, but you could see it over here in the comfort of your home with a beer in your hand.
But what about 2023? What's the resolution? Markets, non-markets.
Spend more time with family, lose a little bit of weight,
And stop going for cricket matches.
and don't lose too much capital.
Well, appreciate your time. So nice to have you back, and cheers
Cheers.
for 2023.